So we have covered the different indicators for the macroeconomy, like we talked about the nominal GDP, we talked about the real GDP, we talked about the real GDP per capita, and we also talked about the growth rate of real GDP and real GDP per capita. Now, besides the GDP, there is yet another indicator of the macroeconomy, which is GNP. Now, in the real world, the GNP is not used as much as the GDP as an indicator for the macroeconomy. However, it is a very important indicator that gives information that goes beyond, above and beyond the GDP in kind of conveying certain very important macroeconomic information. Let us first understand what is the GNP. So, the GNP is an acronym for the gross national product. And the definition of GNP is the total value of all final goods and services produced by the citizens of a country during a current accounting period. So here lies the difference between GDP and GNP. Please note that in case of GDP, GDP was the value of all final goods and services produced within the geographic boundaries of the country. It did not matter whether the goods and services were produced by a citizen or not. For example, I am still a citizen of India, but I work in United States. I work within the domestic boundaries, the geographic boundaries of United States. So the value of my services gets accounted in the GDP of USA because I am on the US soil, although I am not a citizen of USA. However, in case of GNP, the location does not matter. Whether the service or the good is being produced in USA or outside USA would not matter. What matters is who is producing. Is it a citizen? Is it a domestically owned factor of production? So a US citizen could be working in Germany and the value of his services would still get recorded in US GNP because he is a US citizen. It does not matter that he is working outside USA. So that's the basic difference. GDP takes into account what is produced domestically and GNP takes into account what is produced by the domestically owned factors of production. So GNP would basically be the C, the I, the NX, all that has gone into the GDP, plus it considers another additional factor Z, where the Z is basically the net factor earnings. It's called net factor earnings, and I will tell you in a minute what we mean by the net factor earnings. But before that, please note that this part, the C plus I plus G plus NX, this is actually the GDP of the country, right? So we can say that GNP is equal to GDP plus the net factor earnings, that is capital Z. Now what is this net factor earnings? The net factor earnings is basically the income received by citizens abroad minus, that's important, minus the payments made to foreigners here. Okay, so it's looking at the money that the US citizen, so if I'm talking about the GNP for USA, then the GNP for USA is the GDP of USA plus the income that is earned by all US citizens living abroad minus the payments, the money that is paid to all foreigners who are working and living on US soil. So that is the GNP. For example, if you think about the Coca-Cola company, it's a factor of production, it's a business firm that is headquartered in USA, but it has its operations, production and sales all over the world. So if the Coca-Cola company produces and operates in India and it earns profits in India, then the production of the Coca-Cola company in India would be a part of Indian GDP, because that production is happening on Indian soil. So the production of Coca-Cola company in India is a part of Indian GDP, but the profits that the Coca-Cola company makes in India is a part of US GNP, because Coca-Cola is still a factor of production. It's a business firm that is owned by United States. It's a US owned company. So that's the basic difference between GDP and GNP. So the difference between GDP and GNP is basically given by net factor earnings. So you can see that the GNP is indeed imparting some additional macroeconomic information which was not captured by the GDP.